Hey everyone, welcome in to another daily editorial here on the KE Report. Another special Sunday daily editorials. We're chatting again with Marc Chandler, managing partner at Bannockburn Global Forex and editor of the Mark to Market website. A lot of developments both in the US and around the world for us to get to just from this last week. We're going to be talking US jobs, Powell's comments, US economic data, as well as looking at what's going on in the Eurozone in terms of inflation and the new government in Japan, as well as China, even though they've been on holiday, what we're seeing the continued, strength in that market, the rebound after the country's easing that they're calling not easing. Mark, I want to start with that US jobs number on Friday. The headline number much stronger than expected. September payrolls grew by 254,000, about 100,000 more than expected. Two prior months were actually revised up by a combined 72,000. Look, the unemployment rate ticked down to 4.1%. We also saw average hourly earnings rise 0.4% month over month, 1/10 above the estimate. Well, one of the negatives that I was reading about that jobs data is that the work week dropped to 34.2 from 34.3. That matches the lowest in 14 years since June 2010. Mark, what do you take away from that September jobs number?
Yeah, sure. What a strong number, huh? I mean, I think that, just when people began fighting and resisting the Fed's call about 50 basis points cuts for the end of this year here in Q4, market was really pushing for an earlier, more aggressive cuts, and we get this strong employment number. And again, like you mentioned, it's not just that the non-farm payroll number was stronger than expected, but the upward revisions were higher. What caught my eye, I think you're right. The hourly earnings and the decline in the average work week. I think this is probably storm related. I wouldn't read too much into it. I think that the real takeaway, though, is that the labor market is slowing, but not quite sort of rolling off the edge of the table, or falling off a cliff. And so, what Powell told the markets very early in the week, he said he was impressed with pleasantly surprised by the upward revisions in GDP and the GDI, the gross domestic income measure, and that he reiterated the idea that we saw in the dot plots of a more cautious rate cutting sequence. And it's kind of ironic in a way. I think this is the difficulty the Fed has in delivering its message. Remember what happened? The market was offset on 25 basis point cut when during the quiet period, a reporter or a story looked like it was planted to prepare the markets for a 50 basis point cut. Now that the Fed delivered the 50 basis point cut, we've had some relatively better than expected data. It's not just the non-farm payroll data, but earlier in the week we had that stronger than expected ISM services number, which the market has been giving more credence to, paying more attention to. And so I think that the market once again is converging to the Federal Reserve rather than the other way around. And by converging to the Federal Reserve, I mean we've seen a big jump in U.S. interest rates and unwinding of those wagers that we're looking at another 50 basis point cut this year by the Fed.
Well, Mark, all this data that's better than expected begs the question where the recession is, because all we heard for the last 2 years was a recession was coming. And then we had those periods of time in the past where we had banking crises or we had the 2 quarters of negative GDP and everybody said they weren't worried. Then the last couple months, everybody's been super worried about the economy starting to roll over. But the GDP numbers, to your point, the Atlanta Fed still has them about 2.5% for GDP. The jobs reports come in better than expected. The unemployment rate is not taking up to a point where it's super dangerous. The manufacturing's improving. The real estate market hasn't fallen apart. And yet the yield curve has uninverted. And everybody said, okay, that's definitely the signal, but things are going to get weak. Why were everybody so worried the last couple of months about a recession if all of this data still seems pretty good economy?
Yeah, I think partly it's about the quality of the data. For example, imagine that people businesses were worried about a dock worker strike, Middle East tensions, and bought a lot of inventories. And so inventories would count as like business investment and that would boost GDP. And so I think people thought that the quality of the data was poor or was weakening. And it's still, I think, fair to say that we've probably seen the best of the economic growth. And what we're talking about, I think, until this past week, I think the debate was between a soft landing and a hard landing. And again, the economic data has proved unpredictable in many ways. This is a very unique business cycle. And I think that there still are a lot of indicators that are concerning, which is why the Federal Reserve cut interest rates. And so I think that, of course, we could have this debate forever, the naysayers always looking for that cloud in a silver lining. I would still be the camp, though, that says that it's not the fourth year of a presidential term that you typically get a recession in the US unless there is some kind of crisis like in 2000 or 2008. That more likely to get a weaker economy next year, the first year of the next presidential term. We'll have to see how it unfolds. But I still don't think that it's out of the question yet that the economy does end up in a recession. And the soft landing idea itself is part of, you could locate it on the business cycle. It's part of the business cycle. It's the belief early on at the end of one business cycle that a recession could be avoided. Most of the time, it's not. So partly, I think we're playing the odds.
So, Mark, where does the recession come from? Or is it simply broad based? Because, look, the data is okay. Some of the data has been trending lower, let's say in the wrong direction, but it's not there yet to say that we're in a recession. Plus, you got to consider what's happening around the world, where some countries have a little bit better data. Some countries are also struggling. It still just seems very much to me like a coin flip out there where there's no easy answer. So, what will you be watching to say, yes, this recession, whether it's deep or shallow, is truly coming?
Yeah, I think that's a good question. So I think partly is, where is the Achilles heel? What typically turns lower? How do we have recession? It tends to be, I think, we often think it's consumption, but consumption is much more stable than one might expect. Instead, it often takes place because capital investment is slowing for various reasons, including maybe they don't see much of a rise in consumption, or maybe they have to draw down their inventories. So I think you're right as well that the global economic outlook doesn't look so good. So sure, China has provided this lots of stimulus. Maybe it's 1.5%, 2% of GDP, but Europe is still struggling, and Japan is not struggling as much, but their economy, I mean, we've seen some very weak economic data, including the industrial production data for September. So I think it's hard for the US to grow if Canada is more or less stagnant, Mexico slowing down, Europe in a weak situation. So, but to your point, so to look for a recession, I think we should see it in the labor market, but that comes with a lag effect. And I think we should see it in different measures of capital expenditures, like we saw earlier this week with the factory orders and durable good orders.
Well, Mark, when you look at the international markets, like you say, when you look at the Eurozone, they've actually had their inflation come down substantially, just like the US has. In fact, many countries have had their inflation come down over time. They're now switching to a more dovish standpoint. So whether you're looking at the Bank of England, the Eurozone, China, everybody is back to easier money policies. And Japan, the standout that's been tightening, has even eased off their tightening. So it seems like it's a world that's got less inflation and things aren't as dire as people were expecting. How does that play into the currency markets?
Yeah, I think you're right. What we saw earlier this week is all four of the large Eurozone members, Germany, France, Italy, and Spain, all had inflation below 2%. And so this has really boosted the wagers that the ECB is going to cut rates. Not only did they cut rates last month, September, but the market has a cut in later this month, as well as another cut before the end of the year. So two more cuts after here in Q4. And the same thing more or less with the Bank of England. The market favors another two more cuts this year. They've only cut once. And so what's happened this week between Powell's comments, as you say, Shad, what's happened in the Eurozone and the UK, and then lastly with the US jobs data at the end of the week, the dollar's had a very good week. So partly US interest rates have risen, and so this has helped the dollar yen, for example. The dollar has risen about 4.5% against the yen this week. Sterling's had a rough time because of an apparent switch in tone from the Bank of England, and so sterling's off almost 2%. The euro's held up a little bit better, but interesting thing with the euro, we've been trading between roughly 110 and 112 for a better part of the past 6 to 8 weeks. we broke through 110 right after the jobs data. There was a large option that was set to expire there as well on Friday. The measuring objective, that double top, is 108. And it seems like a deep pullback to me, a deep correction. I'm looking at least initially supported around 109. So bottom line here, with other central banks in Europe talking about more cuts, the push from the Fed away from another 50 basis point, we've seen a big move in favor of the U.S. through the interest rates. The U.S. German spread, 2-year spread, was down to about 135 basis points in late September. And we're back at 175 basis points now. And so that just is meant to illustrate that this week we've seen a big jump in the U.S. premium, and this is what's really given the dollar this across-the-board lift.
Mark, makes sense for me then. This dollar strength, we've also seen commodities strong during this dollar strength. So does that play into some of this stronger economic data? Does it play into some of this easing that we're seeing? Just because the dollar's rising, yes, it could just be because other currencies are getting weaker. So how do you pair off those two moves? Commodities also doing well.
Yeah, no, that's a good question. I mean, I want to really break down what we mean by commodities. For example, I'd say that we've seen over a 10% rise this week in the November WTI futures contract, 10.5%. And I think that has nothing to do with the dollar Fed policy. I think this is purely because people like myself are worried about what's going on in the Middle East. It's hard to know whether Hamas and Hezbollah, are they proxies for Iran, or is Iran a proxy for Russia? And like, can this spread? Can Iranian refineries be hit in a missile strike? And so we've had this big rally in oil. I think that we've seen a higher copper prices too, and I think this is partly some of the industrial commodities are more about China's stimulus and maybe some short covering belief maybe China can turn the corner. Not so much that the packages are big enough in and of themselves, but that some of the measures will help boost confidence, which could unleash a lot of this pent-up household savings. So I think that you could have a period in which the dollar could be rallying like it is. You could have higher commodity prices, nothing to do with the dollar. I would note, though, that gold is finished last week on a soft note, virtually unchanged after the earlier gains.
Well, Mark, let's dive in a little bit more to the China story, because I think you're right. A lot of the base metals and even some of the energy is really moved by China, the world's second largest economy. I mean, these are global markets, but China is such a player in the commodity space that if they're investing more money and they're making it easier and lifting the restrictions on banking to be able to lend more and lowering rates to boost their housing market, that does help things like copper wiring, that does help things like iron ore and steel, and it does help, the commodities across the board. How much of that do you think is sustainable? What do you think this move in China is going to do on the global stage? And then how are things setting up as they come back from holiday next week?
Yeah, I don't know. I mean, I think that there's many critics on Wall Street and the financial markets and policy-making circles who won't believe that China can improve unless it changes its ideology. I had this great quote from Krugman talking about how the Chinese economy is hitting a great wall. And the quote I have of him is over 10 years old. And so I think that people in the West are often skeptical about how China can do anything right. But I think that, even before this latest stimulus, what are we talking about? China growing more than 4%. It's poor by their own standards, but still, most countries envy that kind of growth. So I do think that China did take some important measures. To me, the most important measures, though, of course, they had to do something about the housing market. I don't think that the problem that China's challenges really stems from having too high of interest rates. So I'm not convinced that lower rates are going to solve that problem. But I do think that boosting consumer confidence, household confidence is important. And so it's partly a confidence game, like it was in the US after the great financial crisis. But China is taking a couple of measures that I think are important from a bigger picture sense. One of these is, I think about one of the standard narrative now about China is that it's excess production, excess capacity, and it's can't consume what it produces, so it sends it out, exports it, and causes trade tensions and crises in other countries. So I think to myself, how did the US, Europe, and other large countries address their own surplus capacity problem? I think it took place, I'd say, call it industry rationalization, concentration and consolidation, mergers and acquisitions, get rid of excess production, get rid of inefficient producers or inefficient plants and capacity. China, as part of their measures, it's not getting so much attention, are going to encourage mergers and acquisitions. And this is one way, like we've seen in the US and Europe, one way that excess capacity will be addressed over time. So look for industrial concentration, consolidation in China. The other factor, the other development I think that hasn't really been focused on very much is one of the challenges in China is they have a relatively small central government and stronger provincial governments, local governments. If China is going to compete with the US, if it's going to rationalize production within the country, if it's going to avoid some of its redundancies, it has to have a stronger central government. This means a stronger central government bond market. And some of the measures China's taken that they've announced in the last week or so are going to strengthen the hand of the central government over local governments. And this also, I think, is an important structural change in China. So to me, yes, cutting interest rates, making it more affordable to buy houses, giving money to businesses, loaning them money to buy back their own stock, all these things boost confidence. But to me, the mergers and acquisitions that will likely take place, that industry consolidation and concentration, and a stronger role for Beijing over the local governments are important structural changes that will help China become more competitive.
So, Mark, where does this all leave the markets then? Because look, central banks around the world, many of them are easing, whether they ease into a recession or not, that can boost markets. And even this week, the markets were really mixed. S&P is pretty much flat on the week, but that's also on the heels of, well, people expecting a big drop starting off this month. We have the election coming in about a month's time, all these different push and pull factors. Plus, we have to consider just how well the markets have done this year to date so far. What are you doing in your portfolio? What do you think about the overall health of these markets?
Yeah, I'm trying to sit tight here. I think that to take a look for the next week or so ahead of us, that the CPI coming out, it likely allow for the year-over-year rate of US CPI to soften a little bit. I think we can, the dollar has been under pressure. I think that we've begun a dollar correction. I think it began maybe a week or so ago, got a little bit more room to run. I've been impressed with the resilience of the stock market. I thought that what we saw that sell-off earlier in September was going to be a more sustained move. It's come right back here. Like you say, the major indices finishing flat to slightly lower on the week, but I think that the soft landing scenario is intact, and the stock market I think has held up fairly well given what's going on with the U.S. rates. I mean, like I say, rates are just in the past week. The U.S. 2-year yield has basically taken back one and maybe a little bit more than one rate cut. And yet the stock market is not just being juiced up by prospects of lower interest rates, but also that maybe people are getting more optimistic about this soft landing scenario that can be extended a bit further.
All right, Marc Chandler, managing partner at Bannockburn Global Forex, also editor of the Mark to Market website, which we will link to in the show notes. Mark, always interesting to hear what you're seeing in the markets and in all the economic data from the US and around the world. We'll hopefully touch base with you again next week. I hope you have a great rest of your weekend.
Thanks. Good luck to everybody.